this is John. I'm going to talk about the models that are applicable to our research article. There are two of them. One is Dunning's eclectic paradigm and the other one is Porter's diamond, otherwise known as the competitive advantage of nations. We've talked a little bit about the context. We've talked about some of the historical events. If you look at the eclectic paradigm, it has three different parts. Ownership, location, and internalization, the OLI. So ownership advantages from a country's perspective would be their resources, their universities. From a corporate perspective, it would be the intellectual property, the processing techniques. It matters which perspective you're looking at here, whether you're looking at it from a corporate, a transnational corporation perspective, or from a national perspective. The location advantages would be that there's this huge market, particularly in China, where you have 400 million people, that's more than all of Western Europe, living in the major cities in China. And here you have the potential for lower production costs, lower cost labor force. And you have the incentives being provided by local government, by the state and local governments to lower taxes, to reduce the tariffs, the non-tariff barriers, special incentives for companies to invest in these city regions. Internalization, that would be something we would talk about more in terms of the transnational corporations, which are what are those things that are important for us to keep to ourselves, to do internally, and not necessarily to share. So I've put together a matrix here that combines strengths and weaknesses from both ownership and from location. And if you're strong in location, which is what this article is saying, and you're weak in terms of ownership advantages, which is the situation that China found itself in after the Mao regime and Deng came into power, and they tried to open up the country. One way to move your economy then is with inward foreign direct investment. Over time, what we saw in China is there's also this movement towards having ownership advantages in China. So there's a transition from moving from a weak ownership advantages into strong. So now we see both of these at play, but the focus of this article is how these city regions grew as a result of opening up China, particularly in terms of inward foreign direct investment. You can see the similarities too to Porter's diamond or the competitive advantage of nations. We talked about the assets, the things that the companies own. Look at that from the perspective of companies who come in or licensing their technology. They're providing the direct investment in China, where they have educated people, they have lower cost workforce, the universities are nearby. We also have these supportive industries, so there's this synergy within these locations. So the traditional diamond is the firm strategy. So if the goals of the company mean that we're trying to lower our manufacturing costs, our production costs, we also believe we have a large market in China with over 1 billion people. Demand conditions, we talked about that with just the sheer demand size, the potential markets. We talked about the value of government influencing the incentives, opening up to and being competitive within provinces as far as in foreign direct investment. We mentioned, I think, the idea of path dependency. Remember that these geographical areas are the traditional shipping ports within world trade for China, particularly active in previous centuries. So these are the two models that we found that were most applicable to the research article about the FDI in China.